Own a house, a piece of gold, even shares in a company. But what if ownership isn't what you think it is? Because right now, assets aren't just being owned, they're being encoded. So when your property becomes code, who actually owns it?
All right, before we dive in, just a quick heads up. This explainer from the channel Blocks Bonds Funds is for educational and informational purposes only, and it is definitely not financial or investment advice.
So, here's our game plan. First, we're going to look at what ownership even means in this new digital age. Then, we'll break down exactly how a real-world thing becomes a piece of code. After that, we'll explore the huge promise of all this, but we'll also get real about the hidden risks. And finally, we'll peek into the future and see where all this is headed.
Okay, let's start with the big, fundamental idea here. The massive shift from holding a physical paper deed in a safe to holding a digital token in a wallet.
And that brings us right back to the central question, doesn't it? The answer, well, it's way more complicated than you'd think. It really forces us to step back and ask what ownership truly means anymore. Now, the tech behind this whole revolution is called tokenization. To put it simply, it's all about creating a secure digital twin of a real-world asset on a blockchain. And we're talking about anything: a skyscraper, a government bond, heck, even the rights to a song.
Okay, and this right here is the most important distinction you need to grasp. When you hold a token, you don't actually own the physical thing. What you own is a legally backed claim on that thing. It's a subtle difference, I know, but it's the entire foundation of this new financial world.
So how in the world does something you can touch, like a building, get turned into programmable code? Well, it's not magic. It's a very deliberate, structured pipeline that bridges the legal and the technical worlds. The whole process really boils down to three main stages. First, you've got to build the legal wrapper. Then you create the digital version, the token. And finally, you make sure the real asset is locked up safe and sound while the tokens get sent out to investors.
That legal wrapper we talked about, it's usually something called a special purpose vehicle, or an SPV. Honestly, the easiest way to think of it is like a super secure digital safe deposit box. The real asset, the deed, the gold bar, is legally put inside this SPV. Why? Because it isolates the asset, protecting token holders in case the company that issued the token goes belly up.
Now, making all this work together requires a whole stack of technology. You've got the blockchain acting as this unchangeable public record. You have smart contracts that automatically enforce the rules. You need oracles to feed in real-world information. And crucially, you have regulated custodians who are physically guarding the actual asset. It's a complex dance, all designed to build trust between the code and the real world.
Okay, so we know what tokenization is and, kind of how it works. But the real question is, why? Why are the biggest names in finance pouring billions into this? What problem is this actually solving?
This slide pretty much says it all. You look at the before, that's the old world. Think about trying to sell a giant office building. It's slow, it's expensive, and you need to be a millionaire to even play. The after is the promise of a market that never closes, that anyone can access, and where deals get done in seconds, not weeks. And all these benefits, they feed into each other. When you make something easier to trade and open it up to more people, you naturally create more buyers and sellers. That alone could unlock trillions of dollars of value that's currently just stuck in these hard-to-sell assets. Plus, you can automate stuff like dividend payments, making the whole system run way smoother.
Fractionalization is the absolute key to all of this. It's the secret sauce. Instead of needing $50 million to buy a building, you can now buy one token for $50. You're not buying the whole building, you're buying one tiny digital brick that gives you a claim on its value.
And hey, this isn't just some fantasy about the future. Take a look at this chart. We're already seeing billions of dollars in real-world assets tokenized today. You can see private credit and government debt are way out in front, which shows you this tech is already being used in some of the biggest markets on the planet. But, and you knew there was a but coming,
It's not a perfect fairy tale. This new tech doesn't just erase risk. Nope, it just changes its shape and introduces a whole new set of challenges that we have to figure out.
At the end of the day, we're just trading old risks for new ones. I mean, think about it. If there's a legal fight, will a judge care about the blockchain record or the old paper deed? Who's on the hook if the custodian messes up? What if a hacker finds one tiny bug in the smart contract code? Or what if every bank makes its own little token platform and we just end up with a mess of disconnected markets? These are the tough questions.
And this quote from MIT's Thomas Harjano just nails it. The tech problems, we can solve those. The real challenge, the really hard part, is getting all the lawyers, regulators, and giant global banks to agree on one set of rules for this new digital game.
So, with all that on the table, where do we go from here? What is the future of ownership actually going to look like?
Well, one thing is crystal clear. The big institutions are already here. They're all in. We're talking JP Morgan, Citi, BlackRock. They're not just kicking the tires anymore. They are actively building the roads and bridges for this new market.
But the final version of this market, that's still totally up for grabs. Are we headed for a future where pretty much everything is a token? Or is it going to be more of a hybrid system where the old and new worlds coexist? Honestly, the answer just depends on how well we solve those huge challenges around laws, standards, and getting everyone to cooperate.
And that really brings us to the biggest idea of all. This technology isn't just about making markets run a little faster. It's doing something much deeper. It is fundamentally changing our relationship with things we own, moving us from a world of physical possession to a world of programmable claims.
And so we come full circle. It all comes back to this one powerful shift from property to code. And what that new definition of ownership is going to mean for all of us, for our economy and our society, well, that's the great question that we're all going to see answered over the next few years.